Hi, I'm Aaron Newworth with ETF Trends and ETF Database. I'm joined by Mark Carlson, Senior Investment Strategist at FlexShares Exchange Traded Funds. Mark, how are you doing?
Oh, good, Aaron. Good to see you again.
Great. Well, it's been a little over a week since the FOMC meeting where the fund rate was raised by 25 BPS and members communicated their outlooks for future hikes. What has been the impact in the Treasury and credit markets?
Well, Aaron, while the tone of the FOMC meeting was slightly more hawkish versus consensus expectations, it was really Chair Powell's comments a few days later that really moved the rates markets, with the intermediate part of the yield curve seeing the greatest moves in pricing yields higher. We now have a very steep curve from 3 months out to 2 years, while beyond that point, the curve is relatively flat, showing that the market is looking at 2024 as a key time period for the economy and for interest rates. And spreads on the on investment grade corporates, especially in the 1 to 5 year range, have widened, with most of the impact coming after the FOMC announcement, with additional widening on Chair Powell's comments as the market weighs tighter financial conditions for the economy and the impact on capital markets.
Well, so the comments Chair Powell provided just days after the FOMC meeting appeared to try and provide such clarity by cementing the view of the Fed's pivot from their focus on job creation during the pandemic to a laser focus on inflation going forward. For you, what are the potential benefits and negatives from this pivot?
Well, it's critical for the Fed to demonstrate their commitment to both their mandates of economic growth and price stability. However, right now, the market, businesses, and consumers expect the Fed to address the current inflationary environment before elevated inflation expectations become entrenched. Ideally, the Fed will be able to manage increases in the Fed fund rates and the runoff of their balance sheet assets in a way that reduces some of the excess demand without cratering economic growth. The risk is that in their pursuit to tame inflation, the Fed pulls back too hard, too fast, and drives the economy into a deep recession. The Fed appears to have acknowledged that its policies contributed to inflationary pressures by extending its zero interest rate policy and quantitative easing beyond what was needed once the economy reopened via the COVID vaccines. The key is that these policymakers need to have learned from this lesson and would be willing to adjust policy as conditions change. Given the amount of leverage within the global economy and the disruptions to global commodity markets and foreign trade from the Ukraine conflict, a significant policy error risks a broad recession. By all indications, the markets are giving the Fed and other policymakers the benefit of the doubt.
So with that backdrop, besides developments in the Ukraine conflict, what should investors be watching for over the next few weeks in advance of the next FOMC meeting in early May?
Yeah, so I would be looking for a couple of things. One would be we still need to watch COVID infections as the fourth wave is going through China, in Europe, and elsewhere right now, and what impact that could have on supply chains, adding further inflationary pressures. Next up, too, beginning in April, we'll have first quarter earnings reports and forecasts. This will be our first look at what corporations are doing to address cost pressures and the trade disruption coming from Ukraine conflict. And then lastly, we definitely need to watch the Treasury yield curve 2 years and beyond for a potential sign of a recession. The 2-year, 10-year spread has traditionally been a reliable predictor of recessions. If the FOMC continues to communicate an aggressive inflation approach and the 2-10s curve inverts for more than a few weeks or say a month, the risk for a recession in the next 6 to 12 months increases, and investors would be wise to turn their focus from the current inflationary environment towards a potential economic slowdown environment.
Well, thank you, Mark. We appreciate your insights and look forward to chatting again soon.
Thanks, Aaron.